Buying an investment property in Toronto looks like a good strategy to build long-term wealth. On paper, property values grow over time and tenants pay down the mortgage. But behind that purchase price, many investors regret their decision to invest in real estate. If you do not factor in these 5 specific friction costs before you buy, your expected profits can evaporate before you get your first rental payment. All right, let's talk about the 5 friction points. First is the acquisition cost. So on paper, you might think, you buy a property, over time it appreciates, the tenant pays down the mortgage, and then that is your capital gains or equity position after so many years. That is one part of the equation, a small part of the equation, I should say. There's more to it. So there are 3 phases when it comes to investing in real estate. There's the acquisition, there's the long phase, which is managing the property, owning the property, dealing and handling tenants, and then there's the exit strategy towards the end. The first phase, which is the acquisition, is we have to take a look at the capital, the double land transfer tax if you're buying an investment property in Toronto. So anything south of Steeles down to the lake in the 416 area code, you're paying 2 land transfer taxes, one to the city and one to the province. In the case of $1 million property, you're looking at just about $33,000 of land transfer taxes, plus your legal fees paid on closing. That is cash that needs to be accounted for, plus your down payment, whether you're putting 25%, 30%, whatever down payment on that investment property, that is an additional cost that you need to account for. So on $1 million, you're paying $16,475 to the province, and then in the same amount, $16,475 paid to the city for a total of just under $33,000. If you are a first-time home buyer, you have to move in within 9 months of taking possession in order to qualify for the rebates. My disclaimer here is talk to your accountant, talk to your lawyer before you jump into buying an investment property so you do not get into trouble with CRA. Now, before you jump into investing in real estate, there are 4 professionals that I highly recommend and advise you have up front before you start looking or deciding if investing in real estate is an option for you. First professional is a lawyer, a real estate lawyer who understands investing in real estate, an accountant who is well-versed when it comes to buying rental properties and, depreciation, cash flow, deductions, expenses, all that type of stuff. A real estate agent who is an investor and has worked with many investors, and then a mortgage broker who is, again, understanding that specific niche market when it comes to financing investment properties. The second friction cost is the renovations versus repairs. So any expense that is for specific, like fixing broken doors, if the stove stopped working or the dishwasher is leaking or there's a leak in the toilet, those are repairs and expenses that can be deducted from your T776, which is your statement of rental income when you file your income tax on an annual basis. And again, I preface this with discuss these details with your accountant who can give you professional advice. On the flip side, capital costs such as putting a new roof, a new kitchen, renovating the bathrooms, changing the flooring, those are costs that add value to the property, and those are taken into account when you sell the property, because that adds to your adjusted cost base, which I'll explain in the next slide. So for example, you buy a property for $900,000. You put $100,000 in the kitchen, bathrooms, floors, a new roof. Now your adjusted cost base is $1 million. So all your appreciation when it comes to capital gains calculations will be calculated based on the $1 million, not the 900, because the 100 improve the property to a higher value, and that will be the baseline from which the capital gains will be calculated down the line. So for example, if you sell the property at 1.2 million minus your new adjusted cost base, which is $1 million in this case, your capital gains is $200,000. And the calculation, as you can see here in this slide, it's capital gain, which is sale price minus adjusted cost base minus your selling cost. And then 50% of that gets added to your income, which most likely will put you in the highest income tax brackets around the 53%. So here's a case study. Let's say you buy something for 800, you put in 50,000 of renovations. Now your adjusted cost base is 850. After so many years, in this case 7 years, you sell at 1.15. You have selling fees, legal fees 50,000. You'll net 1.1. So your capital gains would be with a 1.1 minus the 850, which will be $250,000. Half of that, 125 grand, gets added to your income. And if that pushes you into the highest tax bracket, you're looking at around a $60,000 tax bill to be paid to CRA. So that is something to take into account. Now, if we give you the full picture, so on a high level, you have the 3 phases of acquisition, managing the property, dealing with tenants and ownership, and then you have the exit strategy when you sell the property down the line. So for example, you might think you buy something for $1 million and a couple years down the line, you sell it for 1.3. On paper, it sounds like you've made $300,000. However, if you take the acquisition and disposition costs into account, and in this case, we're using on $1 million, you have about 33,000 of land transfer taxes. Let's say you put in capital improvements such as a new roof, kitchen, bathroom, floors, 80,000. So that's an additional cost. Then you have selling and legal fees of 60 grand. And then you have to pay the CRA around 36,000. You can see quickly that your 300,000 capital gains has shrunk down to about $90,000 over those years. So that's something to take into account. Now, the other factor, which is not shown here on the slide, is over those years, you also have mortgage pay down. So it depends on your interest rate and your amortization, whether it's 30 years, 25 years, or 20 years, you will be building equity into the property because the mortgage balance will be decreasing over those years. The fourth friction cost is managing tenants. This is the middle phase of investing in real estate, and it can be emotionally depleting. The constant requests and expectations of tenants can take a toll over the long term. Over the years, working with many investors, I find this phase is the most overlooked part. Hiring a property manager is an added cost that needs to be taken into the cash flow calculations. The fifth friction cost is the economy. Reality is, up to 2020, the real estate market was fueled by low interest rates, immigration, and foreign money. Things have changed. The economy is stuck in first gear, hovering close to zero GDP growth. Canadians have one of the highest debt levels in the G7, and Canada's trade relationships are uncertain, to say the least. This puts downward pressure on the economy. Economic growth, which translates into property appreciation over the long term, is not what it was prior to 2020. This is another factor to take into consideration, because what happened before 2020 with respect to property value appreciation, I don't see happening in the foreseeable future. And this is where more conservative numbers when it comes to property appreciation must be taken into account. So in the past, where 4% annual appreciation made sense, I believe now 2 to 2.5% annual appreciation, and this is specific to freehold properties, makes more sense. On the flip side, if you own a condo, that appreciation right now is actually negative territories. It's more of depreciation as opposed to appreciation. And I don't see these values coming back for a long time, for a couple more years. Investing in Toronto's real estate creates long-term wealth, but only when you calculate your net entry and exit costs before signing a purchase agreement. If you want to make sure your next real estate move is backed by exact numbers, click in the link down in the description to get my investment property calculator. This is something that I've personally built over the years as a real estate investor and working with many investors. It will help you see the big picture before you jump into real estate investing. If you own an investment condo, watch this video right here to see why you need to sell it now, because waiting is costing you thousands of dollars. Thanks for watching, and I'll see you in the next one.